big money in this space is not made in your 6 or 7 or 8% cash flows. Like they're good to have. It's a good defensive thing to have for your deals, but really it's that appreciation you're going to look for. Then once you've made it and you have that big appreciation, you have those big exits for you. Now, you take a lot of risk off the table. You get more liquidity, you get more diversified into your debt, you get more consistency. So to me, there's the kind of that investor cycle that I tend to preach in my message of if you want to hit your investing goals fast, don't go the way, don't worry about the cash flow too much right now. Worry more about the upside and the risk adjusted return. Then, you can go cash flow kind of later down the road once you've had your equity multiplied to where it needs to be.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Brian Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Let's get started and reach those peak profits together.
Welcome back to another episode of Peak Profits. Today we are joined by Justin Moy. Justin is a professional passive investor and fund manager with a strong track record of LP or limited partner investments in commercial real estate. Justin specializes in helping others invest passively through fund models that prioritize risk-adjusted returns and long-term growth. Justin, it's great to have you on the podcast. I know that we've known each other for a little while now, but it would be great if you could introduce yourself in a little bit more detail than what I did.
Yeah, totally. It's cool to be on the show. Listen to a good handful of episodes since you guys have published, and we're working on a couple things behind the scenes together too. So it's nice to get to sit down with you guys on a little bit deeper basis. But yeah, I mean, you hit a lot of the highlights in the intro. I don't like to drag on too much about me, but I've been in the real estate game since I was 18 years old. I luckily, stumbled upon an internship when I was 17 in a commercial real estate office, and I was making pitch decks and I was going on tours with brokers and I was calculating commissions was a big part of my role too. And that's when I thought to myself, oh my God, I think I want to get into the real estate field. So when I was 18, I didn't know what I wanted to do, but I know I didn't want to go to college, at least not right then. I went later, but my parents were kind of, hey, what are you going to do? And I said, hey, I think I want to sell real estate. So, when I was 18 years old, I got my real estate license, and that kind of kicked off what's been, a long and fun and an incredible career in real estate in all sorts of aspects, either helping people buy and sell or buying and selling myself or investing in larger commercial deals or smaller deals that I don't really do anymore. And then as you guys know, it kind of opens your eyes to other things. Once you invest in an apartment building, then you get into debt funds, and then you get into like industrial buildings, and you get into like hotels, and you just realize how big the world of investing and alternative investing is out there. And so that's kind of the path that I'm on now is what's next up. Is it going to be apartments forever? Is it going to be other stuff that kind of goes beyond that? There's a lot of assets that I like and don't like right now, but we can get into all that stuff later. But yeah, pretty long career in real estate that I've been happy with so far.
That's awesome. I think you're about 31 now, so roughly 13 plus years now in the real estate space. Got bit by the real estate bug early.
Yeah, just early. I was calculating those commissions, man, and when you see what those commercial brokers in the Bay Area are making sometimes, you're like, man, I think I could see myself doing this.
Yeah. And you see it on like HGTV, or not HGTV, when you watch like a $1 million listing or something, then they flash those big commission checks on the screen, and you're like, wow, one deal per year can be life changing.
Yeah.
Especially when you're talking about, expensive real estate. But so when you got into it at 18, what was the journey like from working within the space to ultimately doing your first investment? Did you do it on your own? Did you buy a single family, or did you go straight into investing as like a limited
Yeah.
more passively?
Man, if you could believe this. So like you mentioned, this is 13, 14 years ago at this point. I sold real estate in the East Bay area of California. So if you're familiar with like the San Francisco Bay Area, you go across the bridge, that's the East Bay. At the time, and this is probably still pretty relevant, the East Bay was like the third or fourth most competitive market in the country. It was like New York, LA, San Francisco, East Bay. And if they sort of accidentally niche down into helping investors buy and sell homes. And if you could believe this, again, about 14 years ago, in the primary market, the third or fourth most competitive market in the country, you could buy a single family home and rent it out long-term tenant, nothing crazy, no burr, no ADUs, no turning the thing into a hotel, like just rent it out, just like people used to do, for about a 5% cash on cash return. Like that was the expectation. And I thought to myself, okay, that's pretty cool. I could envision myself, there were a lot of brokers that were very successful. They would buy like a property a year, and then they had this portfolio. And so that was ultimately my goal. I said, okay, I want to buy a property a year. This looks like a really feasible way for me to retire. And the year after that, my second year in the business, it was like 3% was okay. And then the next year in the business, like if you could break even, you were super happy. And now, people have kind of gone off the rails and I don't know what the hell they're doing. Like they buy these short-term liabilities, feed cash into it every single month. It's like a forced savings account for them. And then they bank on the appreciation after. So I've seen the economics of the single family space just deteriorate, in my opinion. And then, now you have people that are buying single family homes and you got to build an in-law unit in the back and rent that out, or you've got to rent by the room. I saw somebody, big real estate influencer, I won't say who, but his strategy for a deal he was bragging about was he bought a home and to make it cash flow, he rented it by the room and built like little mini storage containers in the garage and was like, and these are $50 each. And it's like, if you have to do this, this is not a good investment. Like, what are we doing here? People are putting up curtains in the living room and saying 2 bedrooms now. Like, this is just craziness. So to me, that vision kind of slowly dissipated. And when it did, I kind of felt like, oh man, like my plan, at 19 years old, I'm like, my life plan is like ruined. What am I going to do? And then, as things would have it, you just kind of keep looking into real estate investing, got into looking at if is fourplexes the answer? Okay, maybe not. Then, I got into, somehow got into the network of like Michael Blanc, who's a kind of a commercial real estate guru in the space, and just kind of absorb that content. And you know how social media goes. Once you kind of pull on one thread, it just unlocks that whole world for you. And then next thing you know, I was going to those conferences and that was a feasible thing for me because as you guys know, commercial is priced based on cash flow. So you don't really have these same obstacles. That's a long-winded way of saying, I stepped right into the commercial investing space with partners. On my first deal, I didn't have the cash, so I had to look for capital partners. I found a couple at some conferences, and then we started doing some deals together.
That's amazing. You really went through the journey of almost having your dream shattered slightly by beginning and wanting to buy at least a property a year, seeing that very,
Yeah.
very quickly decrease. And now you've ultimately 13 years later kind of helping people as you were back then. So you've successfully gone from the single family kind of buying and selling, and then you ultimately have invested your own capital. So can you talk us through how you did the due diligence on your first commercial real estate deal? You mentioned there that you pulled in partners for that. How did you go about finding that deal? How did you go about finding those partners? You mentioned at a conference, but what did that ultimately look like and how did that all really kind of snowball?
Yeah. So when I started in the commercial real estate field, like the syndication field, there's really a couple key verticals that you can fill out. You can do capital raising or bring the money. I knew I didn't have the network or the ability to do that, so that was out. Even though that was ultimately what I wanted to do and what I do now, it just takes a long time to kind of build that reputation and build that network to be able to pull capital from. Other than that, you can do acquisitions, which is underwriting deals, finding deals, getting deals from brokers and putting them into your financial model and seeing like, hey, what can we pay for this? Like, what are our projections? What are comps? All that stuff. And then you could do asset management. Now, we didn't have any assets under management, so there was no asset management role. I couldn't bring the money, so I couldn't be the capital guy. So I kind of defaulted into underwriting deals, which is not my favorite thing to do, but it was a means to an end, and I'm glad that I did it. I spent the first 2 years in the commercial space just underwriting deals. I mean, I underwrote thousands of deals. I would just go on LoopNet, sort by new, and then just underwrite like anything I could. And eventually, I was kind of doing research in markets. I knew I really liked Midwestern markets for a lot of their kind of stability. And I felt like I lived in Phoenix at this time. I felt like Phoenix was just so hot. Like you couldn't really get anything there for a good price. And I stumbled upon this property. It's in St. Louis County, nicer part of St. Louis County. And it was a total POS. I mean, it was broken down, like nobody lived in it. It was abandoned. And so I had a mentor in some of these programs that I had talked to you about. So I brought it to him and said, hey, like, what do you think of this deal? And he said, well, that deal is very risky for like your first deal. So I don't think I would do it. Now, when we went to the conference, the timing just worked out really well because I had met a guy that I got along with really well. And, naturally, hey, what do you do? And he's like, oh, I'm in construction. I build houses and apartments for my regular job. So I'm like, hey man, I got a deal for you. Like, why don't you check this out with me? So, I'm of the mindset that hire help, like pay for a coach, pay for a consultant, like they're going to help you out. So I had my paid consultant and paid coach look at it, underwrite the deal with me. I had this guy who professionally builds properties, underwrite the deal with me. Next thing we know, we're flying out there, we're checking things out, we're walking it, we're doing all the pictures and stuff, doing all the measurements. And, we just kicked off from there. So it was a bit, I'm a big believer that you make your own luck. So it was a bit lucky that the timing just worked out. The conference was just there. I just so happened to meet this guy who had the opposite strengths of me. He didn't have time to underwrite a lot of these deals. He had connections to a lot of capital because he raised money for his deals. So a lot of those things just kind of fell into place, but they fall into place by you doing the same stuff every single freaking day, man. And for me, that was underwriting deals.
That's awesome. And I completely agree with you. You create your own luck by taking actions every day and taking actions with where you're trying to get to and people you're trying to meet, and all of a sudden your network's growing and you have the right conversation at the right time, and all of a sudden it unlocks doors that wouldn't have been unlocked for you if you didn't, again, take action in pursuing that stuff. What kind of property was that, and did you end up closing that deal as your first deal in commercial space? And if so, did you end up going full cycle? Do you guys still have it? Can you kind of dig into a little
Yeah.
bit of those details?
Yeah, we did. We closed on that one. We still have it. The time to sell it was, in the historic rise of interest rate timing. So, the big awesome exit that we were going to have, we're kind of still delayed on that. So, we have time. So I'm not really too worried about it. The property is in obviously much better condition right now. Everything's going well. I think, looking back, it serves a tenant base that I'm not really crazy about. It's kind of a little bit of a lower income tenant, a harder to manage tenant base in an area that's just kind of it's doing okay. So I think there's a couple things that for my first deal, it was really, really helpful. It was awesome to get off the ground. It also showed me a lot of maybe the risk of taking on big, big, big value add projects. The risk of even things like remote ownership because none of us were present there, and so we saw numerous delays and we saw issues that he's like, hey, this would not ever happen on my work job because I'm here every day. So it helped me understand some things that are very important beyond kind of a pitch deck or beyond an underwriting model that are additional risk factors for deals. But yeah, still waiting to see how that shapes out. But it'll be okay. It's just gonna take a little bit longer than we thought.
And this is a multifamily deal, I'm assuming?
It is, yeah, it is smaller multifamily deal, about 38 units.
Oh, nice. Very well. Cool. So when did you first purchase that then? I don't know if we got the
Gee,
year.
I think this was maybe at this point, this is probably 5 years ago. I think,
Okay.
yeah, something like that. I don't know, man.
Yeah.
All
So
these years kind of blend in together.
right.
Yeah, it hasn't been too long. Real estate's a long game, and I understand that. And thinking, yeah, it was probably about 5 years ago because I think the original plan was to sell it around the third or fourth year, and that was kind of around that time. So this is probably going on maybe the fifth, I think.
Very nice.
You mentioned there are a number of kind of lessons that you learned throughout that process, like living out of state, the construction and the value add that it takes. Do you have like third party property management within there, like, or do you manage the property yourself? Like, how does that work today on a day to day
Yeah, it's a
basis?
third party manager, and she is awesome. It's if you're going to do third party management, that's fine. I think a lot of people, when they look at big investment decks, they kind of put a lot of weight on like vertically integrated management. But I don't really agree that that's always the best case. So we have an awesome manager there, and ultimately, I think the biggest lesson that I learned was all the risk of remote ownership. And, I always like to say remote owners and more passive owners are the most profitable clients for property managers and contractors. It's really hard to manage a deal, and you can do all the video walkthroughs you want and you can do all the surprise check-ins, realistically, but a couple times a year. But to keep a project on track, you really have to be present. And so when I invest now, that's a big key point is like who on the operations team is going to be on site. How regularly, how often, like what are you doing on site? Do you live there? Are you flying in? Like what is that going to be? And that to me is a non-negotiable now. Like you have to be present, you have to be on site. I don't invest in remote ownership deals. And then also the value out of risk and the risk of things like permits. In some of these counties, the permitting process is very, very difficult. Now, when you have a project that is an empty building and then you want to fill it up, there's a lot of inspections in some of these counties, especially the more liberal leaning counties. Those inspections are not always consistent. We had lots of delays because one inspector would come out and say, well, the range has to be this way, or like the wall has to be this way. You got to finish the electrical this way. And then we would fix it. Then the next inspector would come out and say, well, the old inspector had an old checklist. This is the new one. And now you got to do this. And so, when you start to pull permits and you start to get into inspections and you start to do Section 8 inspections or all these things, like you're adding a lot of risk to the deal. And then if you're not present, and you're just adding so much more on top of that. So I think those were the biggest lessons for me is now I don't really like to do projects that are big enough to warrant inspections or any type of like permittings. And two, remote ownership, deal breaker for me. Somebody's got to be on site when I'm investing in a deal.
Yeah, I think there's a lot of important points you make there. I'm based here in New York City. Chris, similar. Like we're not necessarily boots on the ground, if you will, which is a term you hear a lot in the industry.
Yeah.
And so we really make sure that we're partnering with operators that have a very strong presence in the market that they're investing in. And that's where their boots on the ground are, right? Like you mentioned, they might be vertically integrated. So they might have their property management team on site every single day, or have a very strong presence in the market and then outsource that third party, but are still right there so they can stop by on a day-to-day basis. You've gone from being an investor yourself and doing deals to now having your own company where you mentioned earlier you're raising capital into these types of deals. So
Mhm.
how has your criteria changed now that you focus solely on vetting deals within
Yeah.
this space and determining which deals make sense for you to invest in
Yeah.
today?
So I think, being in that position of underwriting deals and running asset management on deals, being involved in property management on deals, has really helped me look at deals now in a certain aspect. So, every single investment deck looks good. Every single opportunity looks good. Everybody says their deal is conservative. All the cells in the model turn green for the deals that are presented to you. Like that stuff isn't really special. What I look for in deals nowadays, and it's the reason why, I only do a handful of deals a year, is a misalignment in the risk reward profile of the deal. Like there are 50 deals this month that will hit my inbox that are value add deals with value add returns. None of those are really that special. The core or core plus deal with value add returns, like that's special. That's something that you're taking on a lower risk profile for what should be the return profile of a higher risk deal. So, how's my criteria change? Yeah, I'm definitely not taking on as risky of deals as I used to in the beginning. You kind of come out swinging really hard and you're okay buying pretty much anything. And I've really tapered that risk tolerance down a lot. At the end of the day, it's got to make a certain amount of money because every deal still has risk. I see a lot of deals, they're like this ultra A plus asset. A deal hit my inbox, I think a couple weeks ago, $100 million deal in North Scottsdale, an area I know very well. Yes, it's very low risk, but there's also no money in it. It's like a 15-year deal. I think it's like an 11% return overall or something like that after 10 years, including the sale at the 10 years. So, I don't want to pull down my risk profile so much that I'm just not making money, but I'm looking for, that core plus asset with value add returns. And to me, that's a misalignment in deals in risk and reward. And if you find a deal like that, that's the deal that you pursue really hard and really dive into.
Yeah. And then how important to you, based on your investment so far, is partnering with the right operator and the track record of success that they've had? Right,
Yeah,
full cycle deals and returns and kind of the portfolio that they hold today and
sure.
full,
Yeah.
you know,
I think, one thing that I have pulled less of my weight on in there is things like portfolio size. You see a lot of these operators now, really, really big retail operators. In the next couple of years, they're going to be realizing some pretty big losses. And I think a lot of people saw size as kind of an insulation against anything that bad that could happen. But we see that that's not really the case. I don't think for me to be comfortable with an operator, they don't have to be the biggest operator in the world. They don't have to have this massive company. I would say the couple things that I really look for is first, they have to have a real company with real processes and real staff. I don't invest in like an individual operator or like one guy and his wife or one woman and her husband, thing, because life happens and people get sick and people die and, all these things happen. And if I invested in one person, that's what I call a single point of failure in that deal. I don't want that. So I only require that they have a formal company with formal staff who can essentially continue things on if something happens with the lead kind of operator that I've vetted and invested in. Second thing is they have to have track record in that space, market and asset class. So this was very common a couple of years back when deals got really hard to pencil. You saw a lot of operators go into different asset classes. Car washes was a big one. Like, I don't know, everybody had a car wash fund all of a sudden, and a lot of those had a lot of rocky starts and tax abatements as well. And there was a big group in Texas who got, they got into the tax abatement space. And I declined to invest in their first kind of three deals. And wouldn't you know it, those three deals aren't going fantastic because there's just so much they have to learn. They did great at managing multifamily, but you add in a little bit of a trick there with tax abatement. Now it's a different game. So, they don't need to have the $1 billion fund. They don't need to have the 10,000 units under management, but they need to have solid experience. They need to know how to navigate certain market cycles. And they need to have experience with this asset class and geography for me to invest with them. And then selfishly, they need to have a lot of money. They need to have a lot of personal money so that they can save the deal if something is going sideways. And they need to have a reputation that matters more to them than that money. And I think those are some really good formulas for strong operators that you should really consider.
Those are three really, really good points, Justin. And I completely agree with you on kind of people getting pulled from pillar to post with the asset classes and trying to jump around. And like you said at the start, it's once you do start looking and you go on social media and you go down commercial real estate, all of a sudden your feeds are filled with, well, this is the best next thing. What about this? What about this? And it can be difficult to really stay in your lane, but I do think it's extremely important that you truly understand, because like you mentioned, there are nuances to everything. Even a value add is different to the core plus, which is different to adding tax abatement in there. So again, there are a lot of nuances with the commercial real estate space. So I really do love how you've kind of broken that down as well with I don't think it's selfish for you to turn around and say that people need to have enough money to save the deal. I think what that really is alignment between the operator and the investors. And I do think that is and should be something at the forefront of everybody's mind when you're going through and you're reviewing these investment opportunities, because things happen in the world. Like you said, people get sick. No one could have predicted interest rates were to shoot up like they did. It's understanding how we can ultimately de-risk as much as possible any of the investments that are being made. With that said, you've done a number of your own kind of LP investments. What was the spark that made you want to go into kind of being that fund manager and doing the vetting almost on behalf of your investors?
Yeah. I noticed that people, they didn't really have this grasp of real estate investing like I had, which made a lot of sense. I got into the space when I was 18, right? And so I had sort of developed a maybe an unusual kind of knowledge base in this space, especially for somebody my age. And I remember one of the turning points, for whatever reason, this moment sticks out to me, is one of my friends was buying, maybe she was either buying a house to live in or as a rental or something like that. I don't really remember. And she had asked me a question about the escrow process that, to me, this is not speaking negatively of her, was it was just like such a simple thing to me. And that's when I realized, like, oh, shoot, like other people don't know these things. Like, they don't even know what escrow. I think the question was like, what's escrow or something. She's like, she says you're going to open up escrow. Like, what does that mean? And I was explaining it to her. And I think that's when I realized, I was like, okay, I have like this very unique base of knowledge, like, that I didn't really know people would find benefit from. Cause, I wasn't, that's just what I've done my whole professional life. Like, I've always done real estate. So I just kind of assumed people knew these things and knew how to look at deals and knew like the risk factors of real estate. Then I started to kind of realize like people just don't. And it makes sense because they do other things. Like, they haven't been in real estate since they were 18. So it makes a lot of sense. So I think that was like the one singular turning point that I thought to myself, okay, like there's something here that is valuable to other people that is easy for me to understand. Maybe I should be leaning into this and doing more of it. And then, I knew I didn't want to be a real estate agent again. I knew I wanted to be more in the investor space. And, as I kind of got deeper into those groups, right, of like the commercial real estate groups, fund management kind of came up as something that I thought aligned really well with my skills and knowledge base and what I love to do. And, that was really the linchpin. So that was like the one moment that I realized, okay, shoot, I'm kind of holding on to knowledge here that maybe isn't so obvious to other people. How can I expose that to the world and become some value here?
Yeah, I think that's strong too, because you have that knowledge and you keep growing it, and that's what you're focusing on, right? And you're continuing to learn, and you're continuing to do due diligence and meet with operators and vet out deals. And you mentioned you get a handful of deals in your inbox every week that you're vetting through. So they're really putting confidence in you to bring them the best opportunities that are out there that you're seeing. So then when a strong deal comes up that you feel really strongly about, you can bring it to your investor base and feel confident that you're sharing such a strong investment opportunity and why, right? And so how many deals are you ideally looking to invest in per year, and what's your strategy, for President's Club investors?
Yeah, I usually say like 3 to 4 is what I do per year. Like single asset investments, like we have a debt fund that kind of opens and closes periodically throughout the year as capital is needed. That does really well. Luckily, I'm not in a rush to do deals. It really doesn't matter to me if I do one deal this year, two or none. Like if I don't find the deal, I'm okay with that. Like, I'm at the stage of the career where I much more value like peaceful mindset of things and a lower stress life. Every deal that I bring out exposes me and my investors to new liabilities and new risks and new stresses, new tax headaches. Like there's a lot that goes into bringing deals out. And so to me, it has to be very, very worth all of that stress and that headache and that risk to bring a deal forward. And to me, I'm not going to bring out a deal that's 90%. Like it's got to be 100% there. And I have to feel totally aligned with it in my heart. And if not, then I won't do it. So a good year for me is 3 or 4 deals that I feel like so good about. I feel very confident. The projections and the risk factors I feel are like right where I want them to be. That would be a good year for me. And what's in the future for President's Club investors? I'll keep running that play. We'll do a couple deals a year if we want. We'll keep growing our investor base in a slow and steady way. I don't really have this vision of having this massive fund where, I'm raising tens of millions of dollars and I don't know who my investors are anymore. I just don't really think I've ever wanted that. So I'll keep growing at the pace that we're growing at. If it's kind of flat some years, it's fine. If we do fewer deals this year, it's fine. I don't really think I have a strict criteria on it.
I think that's a really valuable piece as well, because if you do too many deals in a year, but like you mentioned yourself, you have how many deals come across your desk every single day, every month. One bad deal could ruin your entire portfolio. No deal is better than a bad deal, as they say. So I think it's really, really important to keep being really diligent ultimately on what that those asset classes would be. You mentioned your debt fund there, Justin. For people that are listening to this that maybe don't understand what a debt fund is, can you just give kind of a high level overview of what a debt fund is for the
Yeah,
listeners?
I love debt funds right now. Debt is like a superpower in the investing space. It is, if you're a lower risk investor and real estate something you want exposure to, you're probably going to look at debt. So it's essentially the money gets loaned out and you get like that fixed return, right? Just like when you buy a house, if Bank of America gives you a loan, every month you write a check to Bank of America. They don't care if the house is broken, if the tenants pay or not pay, if there's a leaky, whatever, like you just pay them every month, a fixed rate. And that's what debt is. That you take your money, you loan it out to other operators who need it to buy deals. Then they pay you a kind of a fixed rate of return. And one thing that I really like about debt is, at least for the bigger, more reputable funds, the investments are very liquid. You have on the more illiquid side of debt funds, you might have a 2-year period or a 1-year lockup period. The debt fund that I'm partnered with it's 90 days to redeem your capital. You can also pick from a different range of risk reward profiles. You can have lower risk debt funds that are all first position loans, high credit borrowers, low leverage in growing markets. That'll pay you 8 to 9%. Or you can go higher risk debt funds that are kind of second position, shorter term loans, maybe riskier borrowers. Like they'll pay you all the way up to, I've seen up to 14%. So you can pick this big range of risk return profiles. The returns tend to be more consistent. You can compound them in most cases. So I really like that aspect. I think debt is something everybody should have exposure to. And it's currently my largest holding. So it's something that I really believe in.
Yeah, personally, I've invested in some debt funds myself, and I like the combination of both the cash flow that you can get from a fixed debt fund
Yeah.
to compared to an equity investment, which may be lower on a cash on cash during the stabilization, but you have more upside on the back end, right, with the appreciation. So I think the combination of both does make sense if you're a real estate investor. And it makes sense to explore both options. And so for you personally, I know you're pretty big on LinkedIn. You have a great voice on LinkedIn. I'm not sure how many followers you have, but it's a platform that is important to share your message and what you're doing. And I know you have a goal to reach $300,000 in passive income by the time you're 39. So I think that's another like 8 years.
Yeah.
And so
Yeah.
that's a lot of time. 8 years, a lot of growth can happen. But Why is that goal so important to you? And obviously that would be an amazing income passively to live an amazing lifestyle. But can
Yeah.
you expand a little bit about that?
I just think it's more interesting, man. I think, when you get into this space and you ask people like, hey, what's your passive income goal? Every single person says the same thing. They say $10,000 a month. And so, it's on one hand, I want to be different, right? And why settle for that? Uh, on the other hand, like this industry can move fast. You hit this point of, and I think a lot of people in the investing space, they've seen those graphs of like returns, if you compound your returns, where it just kind of hockey sticks up, where like you're not really making that much, and then all of a sudden you are. And so I think really the distance between, let's say you don't want to do 10 grand a month, you want to be different, you want to do 200 grand a month, or like, or I'm sorry, a year, or 150 or whatever. To me, you're really not that far away on a compounding return basis from just going a little bit higher. So to me, the difference is not that great. And if my goal is 200 versus 300, then I'm also thinking about what I've made being active, working at different jobs, commission-based jobs, things like that. I was a high income earner back then. So for me to accept, 100 grand a year, 120 grand a year, or something, it's just not going to cut it. So I need a little bit more. And to me, the way that these returns compound and you can kind of grow your equity in such ways in real estate, 300 grand is really not that much further from 200. And so why not shoot for the higher numbers is the way that I think about it.
I will tell you that my first response to that question was 10 grand a month. So I think I've asked a number of people that question too, and 10 seems to be
Yeah.
categorically the first answer that everybody says. Now, again, it is a great goal to get to that. To your point, $120,000 a year. To some people, that's a lot of money. If you're a high performing sales professional, that doesn't become a lot of money for you, and you are looking at the 200, 300, 400, 500, and in some cases even more than that a year. It's really interesting that that's specifically your goal, and I'm probably going to adjust mine on that as well to focus on something slightly different as well. One of the questions I did want to go back to again there is you said that you're very heavy in the debt fund space at the moment. Like, how important is it, do you think, when you're speaking to your investors, that they have a balanced portfolio? Again, moving that money around at various different stages of their investment cycle. Like, can you tell us a little bit more about how you would speak to your investors about?
Yeah. So I think, my methodology on investing has kind of been, growth before cash flow. And in that way, you can really grow a lot faster. So, if you talk about like an average value add deal, you're probably looking like 20% average annual return, right? Double your money every 5 years. Most people would consider that like a successful value add equity deal versus, let's say you're going to lower risk debt fund. Let's just say 8%. That's very conservative, very doable. Every debt fund should probably pay you that regardless of interest rates. Every single month you get your check. Well, if you have 100 grand and you're going to go put it in a debt fund, okay, you'll make 8 grand that year. That's great. But you're not really, you're not making 10 grand a month even there, right? Like it's going to take some time. That's going to take a lot of time, a lot of reinvestment, a lot of compounding. Versus if you're able to take that 100 grand and put it into value add deals and they do go according to plan and you do double your money in 5 years and now you've got your two. And then you put in another value add. Now you've got your four. And along those years you've invested as well. Like those things can compound very quickly. So instead of waiting kind of that 8%, 9% cash flow range, that's going to take you 3 or 4 times as long to hit your real goals. If it's 300 grand a year or 200 grand, whatever it's going to be, then if you grow first and then, once you've had that your equity multiplied, then you can put it into your cash flowing deals. So to me, I think people kind of might get the priorities wrong in real estate investing a lot. They think of like the cash flow first, but really the big money in this space is not made in your 6 or 7 or 8% cash flows. Like they're good to have. It's a good defensive thing to have for your deals, but really it's that appreciation you're going to look for. Then once you've made it and you have that big appreciation, you have those big exits for you. Now, you take a lot of risk off the table. You get more liquidity. You get more diversified into your debt. You get more consistency. So to me, there's the kind of that investor cycle that I tend to preach in my message of if you want to hit your investing goals fast, don't go the way, don't worry about the cash flow too much right now. Worry more about the upside and the risk adjusted return. Then, you can go cash flow kind of later down the road once you've had your equity multiplied to where it needs to be.
Yeah, I think that's a strong message because when you look at that example and you're investing in a debt fund at 8%, like you mentioned, lower risk, much lower risk than what you might
Yeah.
typically think about a value add play being that's paying you 20, right? And over 5 years, that 8% at $8,000 a year, you're making $40,000 of income. That's also treated differently from a tax standpoint, right?
Yeah.
Is if you have an equity play with depreciation and a value add play. So $40,000 over 5 years versus potentially $100,000 over 5 years. And I think that's the balancing act that all of us as investors are trying to determine is where's my risk?
Yeah.
Where am I comfortable with? And in between $40,000 in a debt fund or $100,000 in a value add play, where do I want to be on that spectrum? And how do I want to balance my portfolio to ensure that I'm still making really solid returns and enhancing the compounding of my money, but in a way that's mitigating risk as much as possible
Mhm.
and
Yeah.
creating a spread across my portfolio, across different operators, across different
Yeah.
markets, potentially different asset classes if you believe in other asset classes as well. And I think that's important as a real estate investor to think about when you're getting into this space. And then I also have conversations with people all the time, around the fact that real estate is also, there's patience to it, just like any type of investing, right? You look at Warren Buffett, who's like one of the most well-known investors of all time, and like most of his profits and his net worth was made after 65 just due to compounding interest. Like he became a billionaire and then his billions just continue to multiply so quickly because of the amount of money he had now working for him.
Yeah.
So it's like, all right, you're going to invest $100,000 into a deal in 2025. You're not going to be rich in 2026, right? Like you invest in a deal, continue to invest over the course of 10, 15 years. Like you do it the right way. You'll be very thankful that you did over the next decade. And I think that's part of my story as well within the journey. I got into real estate about 10 years ago when I bought my first house in 2016 and seeing the path of appreciation and cash flow in the different properties I have and now the investments. And I think that's an important message to also send to investors is like, get started today because the best time to start was yesterday.
Yeah.
Right. But also ensure that you're making the right investments and you're calculating your risk the way you feel is best for your strategy, but give it time, right? And commit to this strategy because the appreciation of real estate in the long run will pay dividends. And again, I think that's kind of what you're alluding to too, is like the compounding effect of an equity multiple versus the debt aspect of like getting cash flow today. Yeah. And that's where, my mindset and a lot of this investment strategy goes and kind of how I think about my portfolio.
Exactly. Yep.
So where you are today within your portfolio, where do you see over the next 5 years? I know you kind of alluded to earlier, like your strategy is like few investments a year, right?
Mhm.
Like really want to ensure that I'm doing strong like investments with strong operators. Where do you see the next 5 years going for you in 2030, continuing to build this company, your investor base and your investments? Where do you foresee that?
Man, I hope I'm almost at that 300,000. I guess that
Yeah.
time's almost up. Where do I want to be in 5 years? I want to be happy with where my life is. You never really know what's coming up. I I can envision myself taking a step back from doing a lot of deals. I can envision myself maybe wanting to build a little bit bigger and do the things like take on staff and help employ other people. That's kind of always been something that I've really enjoyed the thought of doing. So it's very tough to say, this next year is going to be really telling. I think I've been talking so much this year that like 2025 and 2026 are going to be generational years for people to invest in specifically commercial real estate. And if that plays out the way that I think it's going to play out, in 5 years, some of these projects will be exiting at some very amazing multiples. And, maybe I'll be back in the digital nomad life and living somewhere else and you'll never hear from me again. That could be a possibility as well. I think that I have a lot of passions in the real estate space and I have a lot of passions for helping other people invest in the space. And on the other hand, too, think about, will it be real estate at that time? It really takes one change of the tax law for real estate to no longer be the best method to achieve work optionality. Maybe it'll be something else. A lot of people like to look at businesses now, buy businesses or buy blue collar businesses. I don't know where HVAC companies came in. I feel like car washes, like everybody's got like HVAC companies that they're buying or something. So, I think we have to adjust to a lot of what can happen, especially in the government side and what's going to happen to yield. Who says that what happened in the single family space over the last 14 years doesn't happen to commercial and lending changes and buying criteria change, so I don't really want to lock myself into something, but whatever I do, I'm going to keep working the process every day. I think you have to love what you do and you have to be totally bought into it and you have to be totally focused on it. And so if it's real estate investing, it'll be real estate investing. If life has changed and it's something else, it'll be something else. But no matter what it's going to be, I'll be 100% present in it and completely focused every day on making it better.
It's amazing, Justin. Where can people that maybe want to reach out to you, learn a little bit more about the deals that you're investing in, where can people find you? Um, Brian mentioned your LinkedIn that is constantly producing content. Like, where can people get to know and find Justin?
Yeah, LinkedIn is probably going to be best. If you go to LinkedIn, search my name. It's just Justin Moy. I post on there every day. I'm on there pretty much every day. I have a podcast. It's called Passive Real Estate Strategies. If you love a podcast and you like to lurk from a little bit further, but yeah, I would say most people get in touch with me on LinkedIn. Like, so I'm there every day. If you mess with me today, I'll get back to you by tomorrow. So that's going to be a good platform. I'm on there a lot.
We'll make sure to put the link to your LinkedIn in the show notes here as well. But just wanted to say a huge thank you for coming on, Justin. It's been a really, really good episode just to kind of understand your overall thought process, how your investors are investing, and where you see this space kind of in the next few years as well.
Awesome. Yeah, this has been so cool, man. Thanks for having me on. And I know we got a couple deals that we are exploring together. I'm so excited to keep working with you guys.
Same here. Appreciate you coming on. Talk soon, Justin. Thank you.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals and let's reach new peaks together.